Join me for Cracking Crypto, weekdays only on ausbiz.
Cracking Crypto is partnered with City Index. Trade shares, CFDs, Forex, crypto and more with a trusted
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Good Friday afternoon to you. This is The Call. We are live from our studios here at Barangaroo in the heart of Sydney's financial district. This is the program, 10 companies picked by you, 2 expert guests to talk about them all in 1 hour. It's Friday the 17th of June. Joining me in studio, which is so nice for the full hour, David Novac from Wealthwise Education and Mark Gardner from Maqro Capital. Guys, welcome, first of all, on this Friday. It would be remiss of me not to get a thought from you on, this rout that we're seeing in equities. This local market, David, how vulnerable is it still looking to you?
Well, I wish I had a crystal ball, but there's a lot of fear. The big question is today, it looks like there's a little bit of a capitulation out there today. I'm actually I'm buying some stuff today. Look, some of the bargains out there, some people are throwing the baby out with the bathwater or the kitchen sink right now on some valuations. So, this is where, you know, when you're cashed up and you're prepared, the investors out there, professional investors who are ready for these opportunities, they're golden, you know. So I'm having a nibble out there, but it does look a bit ridiculous. I mean, look, I'm a derivatives trader as well, options. So what I just did this morning is sold some what they call put options out of the money on BHP at 41.02 strike price. So I'm getting about 43 cents premium. So in other words, BHP would have to go down below by next week, next Thursday, below something like, what's that, $40.50 for me to lose on that trade, and you know where the stock is today. So to me, I'm happy to pick up BHP down there. So I think BHP is just overdone here. It's just an overreaction. So as a volatility trader, which is what I am in derivatives, I see great opportunities out there when there's a lot of fear. So, you know, depends which side of the fence you're on, of course. But there is a lot of recessionary fears out there with the Fed raising rates. I think, you know, you don't want to kill the golden goose. You know, they've allowed this to go too far. This is the problem central banks have done for a while now, since all the way back, going back to the dot-com mania, and especially the GFC. They just went too far with it. You know, they started to do it in 2018 in December, and they just did a 360 and went, you know, backflipped, and that's where they've lost their credibility here. So I look, my thoughts are this, is that yes, of course, there's recessionary fears out there, and I think the inflation rate you may see to ease off, and I just can't see why raising rates is going to solve anything at the moment. So I think they're backed in a corner right now.
And they may back off, is what you're implying.
Exactly.
All right, I know that's your view, Mark, but in terms of this local market, the selling isn't over, or is it? Could this be a bit of capitulation happening
It's
now?
very dangerous calling the low. Look, I did a bit of relative value sort of studies, went back to December 2019 to basically get some, because obviously we've had that massive rally in the Nasdaq and the S&P, etc., just to try and get some sort of broader perspective on the market. I mean, we're now pretty much every global index is down about 7% plus, probably closer to 10. Hong Kong down 30 from that period. Interestingly, with the Australian market, we're now down 7% since that December 2019.
Yep.
Yet company profits are up 46% over that period. So I think that, look, this isn't a market to be, I think fundamentals have hurt you because you probably would have been getting in far too early, because at the moment the market's been driven by pure sentiment. But I think from a relative value point of view, look, if you're invested, it's a really stressful time. If you're coming in with cash, you'll be rubbing your hands together.
Yeah.
So it's different. Glass half full, glass half empty. But we've been buying a little bit of gear. There's some big distributions coming up from that last dividend season, and from we've pretty much just started basically through this week. But that at these prices, we're looking at beta shares leverage long in the ASX, being it'd have to be north of a 6% distribution there. So
that's the beta shares geared Australian equity hedge fund. That's an ETF, and we've just got two sort of bonus insights into what these guys are buying. Let's find out if there is any opportunity in any of these names. We'll be discussing Woolworths, Block, Michael Hill, Wiseway Group, and Star Entertainment in this first half hour of the show. But stock of the day, I thought we'd have a look at GUD. Out with a market update stating underlying earnings for the year should come in around $150 million. It says that it's expanding its portfolio, but it is warning about supply chain issues. This is a profit downgrade that came through. So what do our experts think about this one? GUD, if you're talking about value coming into the market, I mean, that is an update that many would debate whether it warrants a near 20% sell-off today.
Oh, look, I just can't help but think this is a little bit overdone today. But obviously supply constraint issues have affected them with the China lockdown and the Ukraine crisis, of course. At their EBITDA, what they've downgraded is from 160 million down to 147 million. Not much of a downgrade, but really to be down 21.5%, I don't know. I certainly wouldn't be a seller down here, that's for sure. I think down here it's even accumulate in my view. But look, they have got supply constraints like many other companies out there. So, but I just think it's overdone down here personally. And again, I think with a lot of fear out there creates opportunities, and this is possibly one that at the moment. But you wouldn't be going guns blazing at the moment. But certainly at this price level, look, it's a solid business. I wouldn't be adverse to picking up some shares down here.
I'm going to call that a buy. So we're seeing GUD evolving toward the auto parts aftermarket. It has made some acquisitions, so really getting into that ability to service some of those, the SUVs and four-wheel drives as well. It's got a pipeline of further acquisitions. Is GUD looking good value today?
Look, I think at best I'd sort of be calling it a hold now, because obviously, the damage has been done overall. It's not that bad. You're certainly not that bad of a business to be selling it down here. I've always found it a bit of a complicated business. There's a lot going on. Their accounts are all over the shop. Inflation, I think, is going to hurt their margins a little bit. The rise of electric vehicles as well is, from a long-term perspective, is going to... there's a lot less parts in an electric vehicle. With oil prices up here and petrol prices the way they are, I think that trend's going to, very solidly switch to cars that aren't going to need as much servicing, etc. But look, as David said, it's not a bad business. Another example of, Aussie Broadband, all they did was lower the top end of their guidance, and since that point they're down nearly 40%. So, down 20% is not. These guys seem to be almost giving, from what, they're a little bit, they move their guidance around a little bit too much. And I think, they've almost created their own problem here. Other options in the space is maybe ARB, etc. But look, it's,
okay.
It'll just be a hold for me for now, yeah.
Let's get on to some of these companies that have been nominated by you, our viewers. Just an early reminder that this is not financial advice. This is not for your specific position. So just take it at that, do your own research. For Mitch, he wants to know about Woolworths. Woolworths, I'll start with you, Mark Gardner. Staples performed well through the pandemic. Woolworths, I noted, saying that it will freeze prices on a basket of groceries just to respond to some of those cost of living pressures. Is Woolworths a buy?
Look, they have been sold off. I mean, normally these consumer staples are a really great, margin of safety in markets. They do have quite a high debt to capital ratio, the highest in their sector, basically. They also have the highest net margin, so hence why they can probably freeze some prices there. Look, supply. It's going to be, rising interest rate risks, inventory management, rising wage costs and things could affect them. But look, it's certainly looking fairly attractive down here. It's, it's not too far away from. It's only about $3 away from, pandemic lows. Those rising wage costs may have already sort of come through for Woolworths. I think they've had, they had trouble getting staff through COVID, etc. And I mean, maybe the extra cleaning fees, etc., might offset that rise in the wages. But look, I know you don't allow a nibble, so I'm probably just going to say a hold at this stage. I'm just a little bit concerned about, technically they're under pressure, and I think in the consumer staples space, I think there's cheaper options out there. Possibly, in the agricultural space, the Australian agricultural food, and then the food ETF in the States, I think, has been very downtrodden as well. So there are other margin of safety options out there in the market at the moment, but
okay.
Yeah.
It's a hold. Woolworths for Mark Gardner. Now, when we get to you, David Novac, technically, to Mark's point, it's coming under pressure. Why would you buy now? Why wouldn't you wait for a turnaround?
Well, because of the valuation down here, it's really, it is certainly presenting some good value. Well, the question is, can it present even more value?
Yeah.
Yeah.
Who knows? Technically, I agree with Mark, it's just not looking great on the technical basis. Fundamentally, it looks great. Their third quarter sales was up 10% to 15 billion. I mean, they've forecast strong free cash flow going forward, 75% payout ratio. So, that supports the dividend going forward. The question is, can you get it cheaper? Technically it's not a buy. At best, it's a hold. But, great business. I mean, they're obviously they can pass on costs as well to the consumers. So right now, you wouldn't just rush in and buy Woolies at the moment, but geez, get ready.
Yeah.
It looks great down here, and technically on the support level, it looks really good down here around $33, just under.
Look for that, or 33 or below. Let's get to the next one on the list for Piper. Well, this is an area of the market that divides people, doesn't it? The buy now, pay later space. So this is Block, SQ2. Every day it feels as if we're seeing outsized selling coming through in Block in response to, growth concerns, price of future earnings, all of, the well-worn path. But is there a price for everything?
Not for this one, not for my money at all. I mean, this is the one that got APT got taken, Afterpay got taken over by Square. I don't know how many times I said this over the last year or so more about the buy now, pay later space. I mean, it's clearly in a bubble, I kept saying. Couldn't believe where Afterpay got to, never made a profit. And then Square, who took over the company, and now Block, they got up to $260 US a share in October, now down to $60 or less. The multiples, the earnings, it's just ridiculous, And yet I heard analysts out there saying, oh, don't look at PE ratios or multiples because you've got to forecast, 10, 12 years, 15 years in the future. I mean, are you kidding? I mean, what kind of crystal ball do you have? It's just ridiculous. I mean, I've been around the place for 40 years now, and the market said, I said, well, that's what they said before the 87 crash. That's what they said before the dot-com mania, the GFC, but this time might be different, Is it different? No, it's not. And now it's coming down to some, valuation where you could look at it, but still trend-wise, earnings-wise, it's not a buy. It's always been a sell for me.
I had a conversation with an analyst earlier on who said that there will be winners still in the buy now, pay later space, whether you think that there's more regulation coming, whether you agree with the business model, whether you debate whether it's credit or not, there will be people using this product. Is Block positioned to be one of the winners out of that?
Look, their broader business, because I actually watched that piece this morning, and it was quite interesting, that perspective. Look, is now the right time to be making that bet? You know what I mean? Like, and it's absolutely categorically 1000% not the time to be making that bet. So, because it's a binary trading decision essentially, because whoever wins is going to win big, and whoever loses is broke. So, the revenue multiple, that's dead until the next big bull run. So, this is what these things were running off. I've had this one, I've given an opinion on this before, and they were Afterpay was making $1 billion and then just re-spending it to try to gain that first mover's advantage. And I said at the time, they need to be growing up as a company, and perhaps foreseeing that they should be putting some of that money away, and not just going on this ridiculous expansion, because rates were never going to stay at emergency levels forever. Look, it's come around a lot faster than everyone thought, but like BHP's got a 20, 30 year plan. Like, you don't have to be BHP, but you can certainly plan a couple of years in advance, and they just haven't done that, which pretty big. I think getting bought out, the Australian owners were
lucky. Yeah,
super lucky. They absolutely nailed it. And look, it's an avoid, but Apple's got this product now. PayPal's got this product now. Everyone's got this product. There's 1,000 new entries to the market in the US. They're getting regulatory under the regulatory microscope as well. I think this is a stock for a buoyant market, not for what we're in.
So if you were Piper, and I don't have the context, but a lot of people, some people did very well and got out, and have made their money in that whole buy now, pay later space. But there are those that are still holding. Would you sell if you owned Block right now?
Yes, to take the tax loss.
Yeah, would you sell?
Yep, absolutely.
Yep. Okay, there you go, Piper.
If she needs some convincing, she needs to find a friend who owns Zip and ask them about their experience with that, and then she'll be convinced. So
there you go. That's look into Block. Let's get on to Michael Hill. MHJ is the ticker code. This is for Lucy. So this is a company many will know in the jewelry business. Not sort of really high end, but really accessible. But we are in an environment where we're really questioning what's going to happen to the consumer. Michael Hill's actually done quite well. But when you look at this company in terms of a buy, hold, sell today, what would you be doing?
I definitely would not be buying it, given the trend. The trend is very negative here. And again, what I've learnt over nearly 40 years around in the markets is, don't buy against the trend. Wait for signs of the trend turning up. If you're a longer term investor, you might accumulate if you've got that kind of fundamental premise. the business, look, it's been really, these numbers are pretty good in terms of their earnings growth, and return on equity's been pretty impressive, I've got to say. Plus, it's got a yield unfranked of around close to 7% now. But even the third quarter update at the end of March, I mean, they're up 11%, and considering comments from the CEO saying even dealing with the Omicron virus, they're very pleased with the result, and they still have a strong outlook and growth outlook in terms of acquiring more store, expanding their store rollout. So look, if you like this space, discretionary items, it's an area that's getting hit really hard at the moment because of these recessionary fears. It's not a buy for me. There's other spaces that I like better than the discretionary space like this one. But look, the numbers are great, but I wouldn't be buying it. But if you've got it out there, you might want to hold. However, the trend is not your friend right now. So the question is, where's the bottom? Don't know. And how much worse can the economy get down the future? Will people stop buying jewellery? More than likely, if they've got to pay off their mortgage or with higher fuel costs as well. So yeah, look, it's not a buy for me.
Not a buy. What about you, Mark?
Yeah, look, incredibly well-run business. It's dropped, about 40-odd%. Yeah, look, at the moment, there's a lot of great options out there that at least have some thematic tailwinds behind them that'll give you the same stats. If you've got it, I'd certainly be happy to hold it. It's probably one of those, I think in the long term, and I'm talking 2 to 3 years, it's probably going to benefit from this. I think it'll take out weaker competition. It's low debt, it's well run. So I think it will come out probably far better out of this sort of market route and out of any potential recession. But when you've got really high quality companies that are yielding more than this, and with PEs lower, and the entire sector is against it at the moment, the selling in the sector. Yeah. It's very hard to say. Look, you definitely would hold it, I think, if you've got it.
Well, that's what I was going to ask. Because why, if you've made good on it through, that peak that we saw in the pandemic, let me just see on my chart. So that was, at the beginning of this year, why wouldn't you sell it to get into some of these perhaps more value-oriented options that are presenting themselves right now?
Well, I mean, look, you may, a lot of clients we've got at the moment are just very, they want to just, let things settle, and they don't want to be moving things around too much. Stock-specific stuff can be very tricky as it stands at the moment. So, if you're comfortable with it and you've been comfortable with the downtrend so far and you're happy to take the dividend, look, it just depends on your time frame. It depends on what sort of investor you are. Look, if you're looking for income, I think this is something that you want to be looking at maybe into reporting season, because by that time, potentially VIX has come back down again, and then some normalities come back to the market, and they're more than likely going to surprise. Okay. Even if they bring a result in anywhere near last result, I mean they're very cheap. Mm-hmm. But do you need to risk it until then? Probably stepping in with new money, I don't think you need to. And there's a lot of other stuff in the retail space as well. It's just big headwinds at the moment. Mm-hmm. But yeah, it's definitely one to. It'll likely lag on the way back up because it is one of those sort of underappreciated companies, I think. So you'll probably get an opportunity once it comes back up. Okay,
hold if you've got it. Don't buy it now. Let's get to number 4. This is for Karen, who writes, in the current market conditions, curious for your views on this one and the sector in general, given input costs are rising. But Wiseway is sort of a logistics operator, if you're not familiar with it. WWG is the ticker code, so sea cargo, air cargo, customs clearance. We're obsessed with supply chains and getting things out and into the world, but it comes at a cost. What do you think of Wiseway?
Look, it's a real micro cap type of stock, and they just recently, at the end of May, announced a 4 for 25 basis rights issue at 17 cents per share to raise about $4 million, and the stock is trading below that at the moment at 13 cents. To expand, to provide more working capital. Look, it's not it's such a small stock. It's not going to attract a lot of buying. It's certainly not from institutions. I'd rather stick to the big guns. That's like WiseTech. I think if you're going to play in that logistics space, WiseTech is the space to be in. Although again, I wouldn't be rushing to buy that one either, just given the trend of the stock and the alternatives out there. So you just want to, like Mark was saying, what's the alternatives? Like, where can you get a bigger bang for your buck? And boy, there's a lot of choices now that are out there that are much better than microcaps like this. So,
okay. I'm giving you a heads up, and our viewers as well. I will be asking you by the end of this program where you can get a bigger bang for your buck, okay? So you can name 1 or 5. I don't care. Everybody would eat them up out there.
I can name a dozen or 2 dozen.
Okay, all right. That's my tease to keep you tuned in. And I will ask you the same question. You can just offer 1 or 2. Wiseway Group, is it, the illiquidity as well that's a bit of an issue?
Yeah, look, it's too small to be mucking around with at the moment. I'd pretty much, reflect, completely echo David's comments there. It's 22 odd million or something, I think. And look, it may do well, but in the meantime, you probably can pick up some great dividends in quality companies elsewhere. So yeah, look, it's certainly way. Return on equity hasn't been great. Look, it's fairly cheap, but the whole market's cheap. So I'd really struggle to. To be allocating cash to micro caps like this at the moment, no matter what the sector.
Yeah.
It'd have to be a really, really solid case, with an upcoming catalyst for us to be considering those sorts of tiny stocks.
Got it. All right, let's get to the next on the list. SGR, Star Entertainment Group. Greg writes, it seems to be scandalous to be worth it, but considering the Crown takeover, will this stock benefit? I'll start with you on this one, Mark. For Star Entertainment Group, obviously regulatory issues, questions as to whether it will retain its license to operate in Sydney, but there is a market, and even in depression or recessionary times, the punters still come out. Yeah,
look, I think there's a million reasons you can probably justify a purchase. There's a million reasons against. At this point in time, I try to discourage clients from investing on the back of a potential, a very speculative potential takeover. The ACCC, as we saw yesterday with Link Market Services and things like that, have been, have been a little bit, haven't sort of just let things just go through as it stands at the moment, and obviously. That's potentially a little bit of a headwind for it being taken over. I'd probably prefer. Look, it's got really quality. It's really good quality property. The higher interest rates are obviously going to sort of put a little bit of a dent in that property portfolio as well. I'd probably prefer something like Aristocrat in this space.
Yeah.
And it's very cheap, and it's. I think you've got a lot more certainty on outlook there, and then but look, gambling rises in a recession, so I think Aristocrat's probably it's a more diversified and a better way of getting some exposure to that. So that's where I'd be heading in that space. But yeah, it's just one to keep on the watch list for now, because eventually someone will take interest because the price will get low enough that it'll be near NTA. So
okay, so that's a hold if you've got it.
Yeah, look, to be honest, I'd switch to Aristocrat. I'd sell it and buy Aristocrat.
Okay, so that's a sell. So we've got a sell there, and I see you nodding with Aristocrat.
Mark must have read my notes. That's exactly what I was going to say. Get out of sell Star and get into Aristocrat. Aristocrat down here is starting to look really attractive. But again, the trend's negative, so you wouldn't be rushing into guns blazing, but boy, Aristocrat's looking really good. This is just too speculative. I mean, there's a independent inquiry going on with the Queensland Attorney General. Why would you be in this space, really? It's too speculative.
Yeah, don't be blinded by cheap prices. There's opportunities, but cheap doesn't necessarily mean good or opportunity.
Yep.
That was number 5 on the list. So time to take a bit of a pause and sum up what we've learned so far. Stock of the day, GUD. It's a buy for David Novac from Wealthwise because it's looking looking pretty cheap right now, and it's a good business, but it's a hold for Mark from Maqro Capital. Woolworths, it's a hold for both of my guests. David says it is looking good value, but technically it's not a buy right now. We'll be talking about momentum, I suppose, a lot through this program, when to time your entry. And again, look, a bonus buy, I suppose, from Mark from Maqro is the food ETF. He just sees that technically Woolworths remains under pressure. Block, it's an avoid or a sell for both of my guests. They do not like this space in general. And Mark just says now's not the time to be making a bet that Block is going to emerge a winner, or even if there are some of these buy now pay later names that do survive. Michael Hill, it's a hold from Mark, but he says keep it on your watch list. I might see a bit of an uptick around reporting season. The trend is negative, though, in David's view. Although it's yielding about 7%, he's just not very keen on the discretionary retail space right now as we see interest rates rising and a bit more pressure on consumers, clearly because of the cost of living. Wiseway, it's a small microcap company in logistics. David questions why you'd want to be in a microcap in that space. Stick with the big guns, WiseTech, and even there it's a matter of the trend. No rush to get into that, but you would want to, in this environment, stick with the big names, and that's pretty much what Mark was saying as well. It's just too small to be messing around with microcaps, and especially when the whole market is cheap. And we will be getting some buys from these gentlemen a little bit later on. Star Entertainment, again, it's a sell. So, you got to know when to sell it. And that's what it is for Star, but both agree that Aristocrat is looking very cheap at these levels. Again, though, David points out that the trend still for Aristocrat is negative, so you wouldn't be going in and buying all guns blazing. It's watch list material as far as Star Entertainment goes for Mark, but again, just too hard basket when you've got quality out there like Aristocrat. So everything that's discussed on this show in terms of two buys gets put to our investment committee. The latest meeting is live for you to watch at ausbiz.com. Let's check in with the portfolio update. Wesfarmers, Elders, and ResMed were added, shifting the original allocations and spending cash as well. So far, the fund is down around 9% on a cumulative return basis since its inception on March the 1st. See if we can turn that around. We've got another investment committee meeting coming at the end of the month. And keep sending your requests, of course, to us here, because this is considered the first filter and always good value and a lot of fun.
Grab a beer, grab a glass of wine, because this is where we just gossip.
It has been easy to get this bull market wrong.
Cheers to you.
Have a great weekend, everyone.
The Last Call is brought to you by Australian Vintage Wines. Invest in the home of Australia's premium wine brands.
So coming up in the next half hour, Monash IVF, Link, Viva Leisure, Waypoint REIT, and Yancoal. Here with me in studio is Mark Gardner from Maqro Capital and David Novac from Wealthwise Education. Guys, let's get to it. Monash IVF, this is for Kelly. Hello, Kelly. Hope you're listening or watching. She's interested considering Virtus just paid out a dividend. Virtus also subject to a takeover. She's saying, I'm just not willing to buy it though, because basically it's all snapped up at this point. So is Monash worth a buy? So I guess she's looking at Monash over Virtus because of what's going on in the takeover front. I had a good chat with Claude Walker from A Rich Life yesterday about Monash IVF. He's sort of looking at this as a good sort of dividend payer right now.
Yeah, look, the numbers, this is looking really cheap down here. They also just acquired a medical centre in WA, so they're expanding. And this is in the IVF ultrasound area as well. So, and that the business, I think is called Pivot Medical Centre, and that's been in business since 1981. So, they're expanding their presence. I mean, they have been hit by COVID, of course, and so they've advised patients to hold off until, they obviously recover from the COVID, and then they're expecting growth in the second half of this year. So they're still anticipating. They gave a trading update mid-May saying that they expect new IVF patient registrations are strong, 5% higher to the comparative period, and a solid platform for growth going forward to next year. So it's just the January-April period that it was down by 26% due to COVID cases. But otherwise, their forecast net profit after tax is 22 million. So on a earnings multiple, I mean, their market cap is around 350 million or something like that. Not overly expensive. And it's paying a reasonable dividend yield of about 4.5% fully franked. So it looks really good value down here. Yeah, look, I wouldn't be adverse to accumulating, not going in guns. But again, it comes back to my earlier point about where's the best bang for your buck right now. It wouldn't be for me here. There's other spaces that are much more attractive in terms of the return on equity you can get and dividend yield. So, but look, it's looking great value at the moment down here.
Okay, now what do you think, Mark? Because counter to that, yes, the COVID issues are waning, but I wonder if we do see a slowdown in economic growth, if people's back pockets are coming under a bit more pressure. Is this discretionary? Is IVF discretionary?
Yeah, look, it's still healthcare, and if people will sacrifice to if they really want to have a baby. So, and it's one of those really horrible things. So I think it is at the discretionary end. So I wouldn't call it purely non-cyclical, but I think it's still in the non-cyclical category because I think there is a whole myriad of things that you would. That you would, if you really wanted to have a baby, you would sacrifice before you sacrifice this. So there is going to. I think this is an absolute screaming buy, just in terms of if we're going to have. I agree with David's point. There is a lot of things out there that have better numbers. However, it's very, very difficult to get something in the healthcare space that yields, that has a PE that's not like 40 and above. This thing's forward PE is even only 17. They've got a huge amount of pent-up demand. They went around and snapped up, I think, some businesses in WA, Queensland and Singapore. I think they've got them, they've done that. It's a really smart acquisition. They're pretty much going to add 4% to their NPAT almost immediately. They're very low debt, but they're trading at half of the sector PE, even on a forward basis, which is fairly underestimated. I've sort of got more of a yield around the 6% mark. That might just be due to pricing, but yeah, look, if this is a good thing to be able to put in your portfolio that's going to be fairly non-cyclical in the event we go into a recession, which realistically is managed to yield that despite the headwinds. I'd be really interested to see, with six or eight new centres and COVID dropping off, and then all that pent-up demand coming through, this thing could perform extraordinarily well. And it's really not a sector that that's going to go as backward as hard as some of those cyclical sectors. So it's a huge buy for us.
Okay, great. Now let's get on to the next one on the list. This is Link for James. James, there's been a lot of news associated with Link as of late. Share prices tanked in the past couple of days. Looks to be some issues with the takeover coming through. It was the stock of the day yesterday, so we can probably keep this short but sweet. Is there any reason to buy Link?
No.
Yep. Okay.
Okay. It's there's a group yesterday announced there's a group litigation order against the company. So that's number one. Why you'd avoid it as well. But also just ACCC is looking at this in terms of competition under the Takeover Act. That there's, it's the offer was I think $5.50 plus the div of 3 cents fully franked or something. However, the ACCC are looking at this because Link has a shareholding in a company that could actually affect competition. I forget the name of the company. Yeah, and so PEXA, that's it, PEXA, and so this is just that's why the stock is down. It's an avoid. Completely avoid. Would you go running from the room?
Look, I wouldn't have even bought this when the market was buoyant. I'm not a big fan of the business at all. Parts of the business are okay, but the majority of it's rubbish. Complete avoid for me.
My guests are getting along very well today. They're very like-minded, but that's your verdict on Link James. And let's get to the next one on the list, which is Viva Leisure. This one is from Tim. Now, I'm just now trying to remember. I think we had a bit of an update coming from Viva just this week or late last week, if I'm not mistaken. What do you think of Viva for Tim?
Viva looks great.
Yeah.
I've got to say, not if you look back at their historical numbers because they got affected by COVID, of course.
Yeah.
Yeah, this is fitness.
This is looking, I've got to say, I haven't looked at this business before, Viva, closely, but I like their numbers and the growth outlook for the company and the centres they're opening up, and they're mostly focused in, suburban regional areas as well. So locality is really important to people going to the gym, and they offer, there's a variety of
sort of different. I know what you're saying. There's different options available.
Of the fitness market, there's boutique, there's standard, there's what they call big box express. I don't know what these are, but obviously I haven't been finding out myself.
Yeah.
Or going to find out, but look, their EBITDA is looking very positive. I mean, on the revenue point, they're making like 9.5 to 10 million every month.
Yeah, and it's correct. They upgraded their guidance just earlier this week on Tuesday.
So look, this looks really good. I'm very impressed that they've got Australia, every state, presence in every state, mostly in New South Wales, expanding at 34. Yeah, they've got about 350 centres or something, but this looks really attractive. I've got to say, I would rate this as a buy.
Buy. There you go. He
yeah.
sounds surprised, but what about that chart? That's not a concern?
Well, it's not. But down here, I got to say, it's, fundamentally, I got to look. You wouldn't be rushing into put all your eggs in one basket. That's for sure, and you never do anyway. But down here, just like accumulate on these numbers that I'm seeing, with the earning EBIT margin of 20% as well. These it's coming down to like where the post-COVID lows are as well. Mm-hmm. So look, the valuation, it's not undemanding, and it's you're talking a low earnings multiple. I think it's like 5 or 6 times. It's
a buy. Is it a buy for you?
It's cheap, but unfortunately, investors aren't really that fundamentally minded at the moment. I think for me, it's more of a watch list. I do agree with David. It looks like a great business. I would be more concerned. We've had the consumer discretionary get hit. That'd be the first thing on my list. I'd be taking off if I was, if I had a household budget constraint, is gym membership or personal training. So, look, I think those figures may be, maybe a little bit skewed because we've had 6 months of fairly buoyant, economic conditions, and people are making good money, and we've reopened, and it's been great to get back to the gym. But whether that, if we do roll into a recession, whether that turns around really quickly, is another thing. So fundamentally looks fantastic, but I'm just a touch wary. I'm a little bit once bitten, twice shy. In this consumer discretionary space at the moment, where things have looked like extraordinarily great value and then gone another 25%. So but yeah, look, I think you've got plenty of justification to hold it. That's for sure. But I would probably like to see the broader consumer discretionary. Maybe a few more inflation numbers, etc. It might be one that coming into reporting season, if it's going to pay some form of dividend or whatever, then maybe you might have a look at it. But there's going to be 30 opportunities there. So.
Yeah, again, it comes back to would it be at the top of my buy list? No, definitely not. It'd be right down, or you could watch list it. But
now you're confusing me.
Yeah,
buy or watch list.
Oh gosh, look, I'll echo Mark's thing. I think look, if you've got it to hold, but you wouldn't be rushing in to buy right now.
I'll
okay?
scratch my buyout.
Right. I'll go back on that, but I got to say it's very attractive down here.
Okay.
In David's defence, we are down 7% this week, and the market's analysts are saying the sky's falling. So It's not
It's
too
not
bad.
easy to be
Not
to
easy
jump
to
in.
be
All right,
definitive.
and don't forget we've got some of David's buys coming up a little bit later on. Let's get to Waypoint REIT. This is for Ian, just looking for a bit of a review on the company, I suppose, looking where the opportunity is. Mark, buy, hold, sell, Waypoint REIT.
Love this. Absolutely a buy. This is the definitive baby being thrown out with the bathwater. This REIT's pretty much designed to be extraordinarily stable. Its debt ratio is at the lower end of its bracket. It's just recently refinanced and lengthened its average financing out to 5 years, which actually reduced its interest costs. So interest rates aren't a worry for this thing for at least 5 years. So, and according to CBA and Westpac, etc., we'll be cutting rates by next year. So maybe it'll essentially sort of ride this out a little bit. It doesn't have any maintenance costs. Everything is on the lessor, so the lessee for any of the costs. It's yielding 10%. Its PE's like in low single digits, and yeah, look, their average WALE is well over 10 years as well. So it's actually trading at a 25% discount to NTA. So even if property prices get scaled back 25%, this thing still is going to be cheap. So and you get a dividend paid quarterly, and you're basically getting 2.5% a month, and just about at these prices. So yeah, absolutely a buy this one. Yeah.
Do you agree on this one?
Oh, totally. I mean, look, I haven't looked at Waypoint before, but I got to say, I was very impressed with, if you're looking for a REIT and something that's defensive in this sector with CPI linking as well, this is the one. I mean, gosh, we're talking about 9% yield here, 9.5% paid quarterly. $3 billion in their property valuation. They've sold some properties, about 26, and they've got 29 properties recently, and that settles at the end of this month, and it's coming in about 141 million coming in. And they're looking at they'll announce what they're going to do with that. It'll either be distributed back to shareholders. They're actually doing a share buyback as well. And I think, down here, I got to tell you, I was very impressed. And I think if you're looking for something that's recessionary proof, this is the one. I actually bought some shares after going through the numbers here. I was that impressed.
Did you?
With it.
Great.
Absolutely, because of the yield. This is better than your Sydney airports, as far as I'm concerned, all those other toll roads. I mean, you can argue with those, but this has got service stations, across the Australia.
they're not going anywhere. And a lot of these leases are indexed to inflation.
Yeah.
And if interest rates are going up nowhere near as much as inflation is, so they're actually getting increased rents. So I think the market has flatly mispriced quite a few REITs, and there is some huge bargains in that space.
Because look at that chart even just over the past few months. So that is a screaming buy, Waypoint REIT, and further capital management likely to come in FY22. So you'd be in for that as well.
Yeah, it's, it was outstanding. So, I'm a buyer.
Yeah, money where your mouth is. I love it. All right, last on the list is Yancoal from Ben. Don't know if he holds it or if he's looking to buy it, but we know that that's been one of the big themes coming through in the past year or so is the price of coal. Enough to make you buy?
Not this one, no. Look, there's been some sort of potential transaction with, I think the Yancoal's biggest shareholder here. I haven't gone through to look at it, but there's a takeoff offer about $3.60 US, which equates to about $5, just over $5, and it's trading above that takeover price. But look, for me, and here's the opportunity. If you look, the coal space is a great space right now. They're just printing money. But if you want to get into this space, this is one of my buys, is through a fund, a boutique managed fund that's been around for 17 years, ASX listed investment corporation, LIC, called Cadence Capital, CDM is the code. Now the viewers are going to love this one because if you want to get into the coal space, if you look at their top 20 holdings of Cadence Capital, which they release every month, and plus they also release the NTA value every week on the Friday close. So last Friday, the NTA value of the fund was $1.17. The stock price is trading at 86 cents. Now, in that portfolio at the end of May, they had 35% cash. They got stocks in the energy sector like Santos, BHP. You're buying at a 25% discount to NTA, and 3 coal stocks: Whitehaven, Coronado,
yeah.
and what was the other one that I just forgot about? But 3 leading coal stocks. You're getting at a 25% discount, plus Santos, and it's his portfolio. I mean, I love, and plus it's a short fund as well, so they've got short positions as well to hedge the downside. Now, I suspect Carl, who runs it, is I've been in the fund for more than 10 years myself. Average return around 13%. Fully franked dividend yield now approaching 9% on the current price, fully franked. So you have to get close to 12, 13% in a bank. And you're getting these assets, and I'd say he's moved probably more than 50% cash easily. So you're getting a discount of cash plus 3 coal assets. So I don't know, what more do you want? I mean, that's, and this is the irrational behavior going on out there that I love, I mean, I'm getting a portfolio of stocks, and you could take a look at the top 20 holdings: AGL, AMP,
Yep.
BR Boss Energy, Champion Iron, Coronado, Flight Centre. Okay, they probably got rid of Flight Centre. Marathon Oil in the US. You've got Santos. You've got Sims Metal, Stanmore Coal, Whitehaven Coal, Coronado. So there's 3 coal stocks in itself. So there you go. If you want leverage into a space and getting at a 25% discount, here it is.
Ben, don't go for Yancoal. In David's view, you want to go for Cadence Capital CDM. Yeah, we'll be looking into that one. What do you think about Yancoal?
Look, it's got a great balance sheet. It's great yield. The coal thematic it's just the necessary evil for the time being. And look, Western Australia's had an announcement recently they're unwinding any kind of baseload electricity from coal, etc. So look, but everyone knows that it's coming eventually. But I think at the moment governments are going to be a little bit standoffish in terms of trying to switch to green energy and add even further household costs pressure to families. So it could be one of these things where they start to sort of step back from that really hard line where we're going to green, and because they've got to get re-elected before this thing plays out, so they may push that back and let someone else make the decision. So yeah, look, David's fund sounds fantastic. I'd still rate this a buy. There's going to be no new coal mines approved, so there's a shortage of this stuff, which is absolutely ripe for more takeover bids. I can understand why they knock back a fight, because they know they're in demand. Their debt, there's very little debt, and I think, as you saw with, I think it was Whitehaven, pretty much paid down half or more of their entire debt just out of profits last year. So these guys are printing money at the moment, and you might be in a situation where, even though it's eventually just going to wind up, maybe they, you probably get enough dividends in the meantime, to pretty much cover most of it, and maybe they diversify, or maybe they just get taken over. But yeah, it's only really trading at I think 1.2 price to assets, so it's not like it's massively expensive. So I think I tend to play the energy space as a bit of a basket, but coal is still a very heavy allocation, and then I'm basically over say 5 to 10 year period it'll be slowly switching out of the green stuff, out of the dirty the brown energy into the green energy, but particularly with these pricing pressures at the moment on households, I just can't see whether
the switch being flipped.
I think it was a lot easier when we had much more buoyant, we weren't worried about inflation, etc. So,
okay.
But at the moment, I think that it's going to
still a buy.
Yeah, absolutely.
Okay, let's just review the last 5 companies before I get a couple of stock picks from my guests. Monash IVF, it is a buy, but in David's sense, it's an accumulate. So you don't rush in, but they both say it's looking very, very cheap. And Mark points out that it is in fact non-cyclical. It's a screaming buy for Mark. No for Link. Don't go there. No need to. Viva Leisure, both are just impressed by this company, the fundamentals. But again, Mark is questioning whether the tide is against it with the rising cost of living. Will people still spend up for their gym memberships? It's on his watch list, though. I've scratched out a buy for David. It's now on his watch list. It's just looking such great value, and he's really impressed with the metrics of the company overall, but I think he's going to watch it to see. Waypoint, this is a screaming buy from both of my guests. Mark says it's a classic baby meeting the bathwater, and David says, look, it's defensive in this nature. He's actually put his money where his mouth is. He bought some after researching the company. So thank you, Ian, for bringing that to David's attention. And Yancoal, we've got an alternative buy coming from David, Cadence Capital CDM. It's an M fund, but it gives you exposure to those coal names plus in his view. Buy for Yancoal, still for Mark. He just doesn't see this green switch being flipped right now, as you just heard. So that brings us to the end of the program, almost. David's been very kind in alluding to all of these better bargains than even some of these that have come to our attention today. So David, like what?
Well, like a lot of viewers out there who know me over the last few years, especially the last year, there's a stock that I mentioned in the iron ore sector, high grade premium iron ores, Grange Resources, when it was 30 cents last year. Couldn't believe where it was trading at that, and now it's $1.40 odd. Got to a high of $1.76, so it's up 500%. Still paying, like on the earnings multiple of 3 times, still paying. I mean, if you bought it within the last 12 months, you would have got a 18% fully franked dividend yield at its current price, right? Which is extraordinary. There's another one that's a sister to this, okay? Much smaller, half the production rate, but grossly undervalued. It's the top of my buy list. It's called Phoenix Resources, FEX, trading at 28.5 cents today. Market cap of 150 million. These numbers will blow you away. They're a mid-Western Australian, again, high-grade iron ore, premium iron ore producer. They truck the ore from mid-Western Australia to the port of Geraldton. They own part of the port. So in their balance sheet, like their balance sheet, they had cash of 86 million at the end of March. Okay? Now, 150 million market cap, 86 million in cash. That'll be over 100 million by June, easily by this quarter, because they generated 30 million positive cash flow in 1 quarter. So you just extrapolate the numbers. They already paid out a 5 cent. This will be their first full year of production, which will knock the socks off when people see these numbers. That the return on equity will just blow you away. And this is already paid out a 5 cent dividend after 4 months of initial production when they started in April last year, which is on a 17% fully franked yield.
Yeah.
So I could go on and on.
That's so generous. Grange Resources, Phoenix Resources,
and
buys.
Cadence.
And Cadence.
I mean, there's many more out there. Beach Petroleum is now, but those ones would be at the top of my list.
You're welcome, viewers. Sector, company specifics, we've got like 30 seconds or so.
Look, I think obviously a lot of those, PLS in the lithium sector, Paladin in the uranium sector. For more of the boring stuff, I think Macquarie is extraordinarily cheap down here. And a few of the names that we've had today, Monash and Waypoint at the moment, and probably Elders for some agricultural exposure.
Got it. Thank you. Thanks, guys. That was fun on a Friday. Mark Gardner, Maqro Capital, as always. David Novac, Wealthwise Education. It's been a while since we've had a chance to speak, so that's good.
Absolutely.
Thank you. Thank you for watching. That's the show for today. You can get your company covered. The call at ausbiz.com.au. Just send us an email. We get to them eventually, and usually in pretty quick time as well. So you can check out that portfolio, ausbiz.co/portfolio, and stick around. The small caps is next.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.